Crazy about my money. Crazy about my money.
What's the most that you would be willing to pay today for an investment guaranteed to pay you exactly $100 1 year from today? Would you pay $90, $95, maybe $99? Well, you'd probably start this mental exercise by considering the possible return you could earn on similar investments elsewhere. Other short-term conservative investments such as money markets, CDs, government bonds, all offer a similar yield right now, somewhere in the 5% range. We could break out the calculator, we could do the math, we could back into a 5% return, assuming that this fictional $100 investment was truly guaranteed, and we'd likely conclude that the most you'd be willing to pay would be somewhere around $95.25. That $4.75 profit on a $95.25 investment equals a 5% return. This is the math done by bond investors when determining the present value of a fixed payment in the future. The lower the interest rates are in the prevailing economy, the higher investors are willing to pay for those cash flows. If interest rates are 1% on similar investments, then you'd probably happily pay $98.50 to earn an equivalent return of north of 1.5%, because it's simply better than the other alternatives. Likewise, if interest rates in the economy are 10%, then you'd have no reason to pay anywhere above, say, $91 for this hypothetical investment. Now, I know math is a little dry and this isn't particularly fun, but it drives home an important point. Interest rates in the broad economy have a huge impact on asset values. More specifically, there is a direct relationship between interest rates and bond prices. In 2022, the Federal Reserve increased interest rates from roughly nothing to 5%. In doing so, bond investors were forced to revalue their bonds to match the prevailing interest rates in the economy. In other words, no one in their right mind would accept a 2% return for a similar investment they could buy and get a 5% return. Thus, bond prices fell considerably in 2022. The Federal Reserve has now held interest rates above 5% for more than 2 years, but the indication is that they plan to begin cutting rates this fall. Now, what impact might that have on asset values? As we've just explained, there is an inverse relationship between bond prices and interest rates. When interest rates rise, existing bond prices fall, and when interest rates fall, existing bond prices rise. Now, all else being equal, if the Feds begin cutting rates, bonds should appreciate in value. I say all else equal because it isn't always so simple and the relationship isn't always linear. Sometimes longer-term bonds rise or fall more than shorter-term bonds. Sometimes it's the other way around. And not all bonds behave the same. Government bonds and CDs tend to be more predictable because they don't have the added risk of default. The value of any bond is the present value of its future cash flows. These cash flows are discounted at the prevailing interest rates and adjusted for the likelihood that the payments are actually received. Several factors go into these adjustments. Still, it's safe to assume that lower interest rates in the economy will make existing bond prices more attractive and drive bonds higher. This chart illustrates investor expectation for interest rates over the next 24 months. With interest rates expected to fall, this may be a good time to buy bonds. Franklin Templeton produced a helpful chart to illustrate this historic relationship between declining interest rates and bond prices. The conclusion is that bonds could offer stock-like returns over the next year if interest rates do indeed decline this fall. Bonds have posted solid annual returns over each of the past 8 cycles of declining interest rates. U.S. Treasuries have led the way, averaging 11% return over the 12 months following the first rate cut. On the other hand, stocks are a little bit of a mixed bag. If interest rate cuts are followed by a recession, then stocks do relatively poorly. If, on the other hand, the economy avoids a recession and has what we refer to as a soft landing, then stocks have historically done quite well. The relationship between interest rates and equities is multifaceted. On the one hand, lower interest rates reduces the cost of borrowing for companies, which can lead to higher capital investment, increased profitability, and potentially higher stock prices. On the other hand, interest rates typically decline because Federal Reserve officials see an elevated risk of an economic slowdown. The pace of economic growth is the main factor influencing the interest rate decision for the Federal Reserve. Signs of a weaker economy increases the likelihood of a Fed rate cut in September, or even perhaps sooner. The next scheduled meeting for the Feds is mid-September. We believe that the odds are relatively high for a rate cut this autumn, but it remains to be seen how stock investors will balance the risk of a slowing economy. Bond investors, though, should welcome the falling rates. If history is any indicator, and it usually is, then we're approaching a time to shift from floating rate yields in money markets and savings accounts into fixed rate bonds that can actually appreciate when bond values begin to rise. As always, each investor situation is different, and we're happy to have these conversations with you at your convenience. We appreciate your continued trust and confidence and look forward to working with you. Thanks.
Money, money, money. Money, money, money.
Crazy about my money.